Well, hi traders, welcome to Good as Gold. It's been an interesting week already. I mean, we've seen the RBA coming out with their announcement. They've given the impression that they're really looking at 2023 for rate hikes to be coming in. Obviously, they're working for wage pressures coming through. 17th of November, we're going to get the next wage data. That's going to be really important for markets. And markets have got very, very excited about the potential for rate hikes, as they have done in a lot of countries, to be honest. And some of that has been walked back a little bit, but certainly, the market is still expecting very aggressive rate hikes going forward. We've seen the Fed meeting coming out. I think they've done a fantastic communication to the market, to be honest. I mean, we've seen the announcement that QE is being tapered. That pace is being dropped off by 15 billion a month and will continue to do so. And that pace will fluctuate depending on economic conditions and being data dependent. But the market, equity markets have roared high. Small cap stocks looking really good. We'll talk about some charts in a second. The dollar's fallen a touch, but yet rate expectations have actually increased. So we've seen a dollar weaker, rate expectations up, and that's an interesting dynamic. But equities are rip-roaring. So I think their communication with markets has been quite good, and therefore a lot of this has been telegraphed in advance, and we haven't seen huge amounts of volatility. We've got the Bank of England meeting coming up in the session ahead. We know 15 basis points are discounted. So if they leave rates on hold, which is probably the just about consensus, then you may see a bit of a dip in the pound. But the chances are then they'll look to raise rates and give a very strong impression they'll look to raise rates in the December meeting, and it might come back up again in that situation. OPEC meeting, we'll talk about some oil trades in a moment because I think oil's really, really interesting here. And then, of course, you've got payrolls on Friday, which is potentially could be another impact for the US dollar trade as well. So let's go into market straight away. Let's just see how currencies have fared, and we can see how that that sort of transcend into gold price as well. But you can see over the last 5 days that the dollar has found a bit of form against most of these major currencies. You can see the NOK is under a bit of pressure. Obviously, we've seen a bit of volatility playing up in the crude price. We've seen Brent crude had its biggest down day yesterday since the 2nd of August. A lot of that down to the fact that oil inventory numbers were weak. We saw a 3.2 million build, or US output was I think the highest since May 2020. But a lot of it really pre-positioning ahead of the OPEC meeting in the coming session, which I think is really key as well. The Aussie dollar, the RBA have moved to a more flexible scenario in the sense that they're less they're less calendar-based guidance of rates going up in 2024. They're more data dependent, like a lot of other central banks are now. But you can see these general risk currencies under a little bit of pressure over the last 5 days. Now, what's that mean for precious metals? Just go on my Bloomberg terminal there. You can see over the last 5 days in US dollar terms, we've seen a bit of gains coming through in platinum and palladium, gold and silver having a bit of a rough ride of what we've been seeing coming through. So let's go straight to the charts and see what the technicals are saying. Now, last week, what I wanted to do is use momentum, that body in motion stays in motion type trade. I wanted to wait for a move above 1810. Well, clearly we didn't get that. So, waiting for a breakout and a closing breakout was probably the right trade in that situation. So we're waiting for, and I continue to still like to do this in the sense that waiting for that move above 1810 to give us a move into 1833, which we talk about is obviously the defining moment for gold in US dollar terms. If we get a break of 1810, 1833 becomes the key level, and then if we can get a weekly close above that level, then I think we're probably going to establish a nice bull trend in gold price, perhaps taking out those all-time highs. In taking the technicals into a much more shorter time frame, now let's go into let's say shorter time frame, but we'll go to the 4-hour chart because it gives us a bit more definition. We can see these lower highs that have been playing through. And so for me to get a bit more excited about gold, I like to buy strength. I don't necessarily like to trade the swings. As a CFD trader, as a leverage trader, I like to buy strength. I like to sell weakness. And I think we really want to see a move back through this sort of 1791 region to give us a callback that we're going into 1810. And that would sense my probability at the moment. But at the moment, we're sort of recouping a lot of the losses that we saw coming through in that session there. You can see the move coming down. We've recouped a lot of that. So it's looking a little bit constructive. Now, do we see the sellers emerge as we sort of come back into this, what was support now is obviously resistance. So it's a bit of a make or break session, but really can't get excited about the upside until we get a break through this downtrend, and then really wanted to sort of accumulate those longs above 1820 at the moment. So it's kind of a tough one to call at the moment. Probably taking a somewhat neutral bias, but just waiting for the trade to come a little bit more closer to me in that situation. Have a look at the what we're seeing in dollars at the moment. I'll take it back onto the daily chart. Because the dollar's really, we saw this big big candle up here. Then we've seen this sort of range of, I won't say inside bars, but we've seen this series of consolidation. The market really doesn't know what to do with this dollar at the moment. If I'm taking a sort of more negative view on the gold price, then I guess we're going to be taking a more constructive view on the dollar. And again, like we're seeing in that gold price, if we can in the gold price, I think really a move through this 94.27 takes us into the highs. This is the key level on the dollar. If we're looking at the Dixie, we've got 94.50. Again, if that can break, then I think gold prices are going to come under pressure because that dollar strength is going to manifest into a weaker gold price. Now, what I think is really important for this is because the Fed have opened the door for rate hikes in 2022. I know they're being flexible about the situation. They've basically come out and said that inflation is no longer transitory. The factors that cause inflation are transitory. They kind of reversed engineered it a little bit. But what I want to have a look at is rates pricing. Now, I think this is really interesting because if you have a look at Fed funds futures here, you can see we've got about 57 basis points of tightening in the next 12 months in the US. That's two rate hikes. Going out to the end of 23, we've got about 4 rate hikes and a bit. And then we've got 155 basis points by that time. So rate hikes are being priced in. By next year, 2 rate hikes being priced in. Now, I would note that Citigroup, having seen the Fed statement, are now calling for 3 rate hikes next year. Now, in a world where if we have a look at market pricing, we can see that if you look at in 1 year swaps in Australia are pricing at 87 basis points. In layman's terms, that's over 3 rate hikes that are being priced into the Aussie curve by in the coming 12 months. Is that going to happen? No, it's not, in my opinion. I think very strongly that the RBA are not going to raise 3 times next year. They've still got macro-prudential to go through. We now still need to see wage pressures above that magical 3%. It's not going to happen, in my opinion. Markets are rich there, so there's probably some good buying in the rates market in short-term yields. But given that elevated pricing, now if we have a look at the US, over 1 month we've got in swaps 52. There's not one country in the developed market, in my opinion, where we're starting to see economists pricing in 2 and sometimes 3 rate hikes from the Fed next year. Now, that's based on obviously a very strong set of assumptions. But if that comes to fruition, like we've seen from Citigroup today, Goldman Sachs are calling for 2. They could upgrade to 3. We're waiting for the rest of the street to sort of catch up with 2 or 3 rate hikes as well. This is not a common situation that you're seeing here where the market is pricing the same degree as economists. Most other markets, the market is pricing in a significant premium to what economists are doing. So therefore, from that perspective, we could say that the rates market in the US has some catch up relative to other markets, and that could be US dollar positive indeed. So if you're looking for a short in terms of fixed income, I think that probably is the place where you're going to see that, and where the premium could catch up is in the US relative to other countries. So that makes me tactically a little bit more bullish on the US. And if we're going to see the US dollar strengthen as a result of some of this data coming in, of course, payrolls tomorrow will be very, very influential in that situation. But let's say inflation expectations continue to push higher, the Federal Reserve are going to be forced to move more aggressively by middle of next year, and the dollar is going to strengthen as a result of that cyclical nature. If you have a look at 2-year treasuries, you can see they've had that nice move up for around 20 basis points, sort of struggled around 50 basis points. But if we are going to see rate increases being priced in, that 2-year treasury is going to move up a little bit higher. We're also, I think, if the Fed are going to control policy, they're going to want to see higher real rates. They're going to want to see nominal treasuries moving up more aggressively inflation expectations to tighten financial conditions a little bit going forward. They're not going to want to derail that, knowing that they need to keep unemployment pushing along and create that maximum employment going forward. But you are likely in that situation, if Citigroup are right and some of these economists are starting to be right, that you are going to see real rates moving higher. I've got an open mind like any other trader. It could go lower, it could go higher, but the fact is if the financial conditions are going to be used as a weapon to tighten and sort of subdue the situation, then real rates are going to move higher. Now, the correlation with gold, you can see here, has broken down a little bit, but I think it will establish itself. If we're going to see negative real rates moving higher, back towards sort of the 0 degree, then gold prices are probably going to go lower as a result of a stronger US dollar. Now, going back to that dollar trade that we've been seeing, again, this is the big level that we're looking at. If gold prices make an establishment up to 94.50, that's going to be a big situation for the dollar. Now, a lot of that's going to be driven what we're going to be seeing in euro dollar, given it makes 57% of this. And that's going to need to take out these lows around 115.20. So if those lows of 115.20 are taken out, obviously the dollar index is going to go along for the ride in that situation. Dollar yen's going to make a move. You'd probably like to see that rate differential catch up, and Aussie dollars probably trade down into 74, maybe 73 cents as well. But for me, given those variables and what we're seeing with rates pricing, given the fact that the US is underpricing relative to other markets, it makes a very interesting dynamic playing through in the gold price, which, as I say, let's go back to that situation there. That downtrend still in play. Will price roll over from here? That's what we're going to be watching now. If we can see price rolling over as that dollar strengthens, as real rates move a little bit higher, then I think we've got a good short for a move down into 17.20. But if the gold market will tell me what it's thinking, I need to see that price breaking that series of lower lows to get a little bit more excited. Now, have a look at the crude price, because I think this is a good one as we come up into that situation in the session ahead. I'm going to have a look at UK crude, because UK crude obviously is the global benchmark. It's what OPEC are going to control. The playbook for the session ahead is multifaceted, but we've seen Secretary of State Blinken putting a bit of pressure on OPEC to try and increase the output that's previously agreed at 400,000 barrels. So has President Biden as well. He wants to see something more punchy. He wants to take some of the pressure, as do a lot of these oil-consuming nations. I know that the US is a net exporter these days, but they still want to see lower gasoline, lower prices at the pump, take some of that pressure off the consumer. I think that's a big political message that's playing through. But he's pushing a lot of pressure onto the OPEC nations to deliver that. And that's going to really come through into the Brent price first and foremost. That's why I think we've seen that big move lower. Now, if we have a look at the, have a look at that chart of Brent prices. I've got the daily chart here. You can see this big topping pattern through. Do you know what I'm going to do? I'm going to take this out to a monthly chart. Do you know why? Because I know no one in the world trades off a monthly chart, but we do get a good feel of the market structure off the market off the monthly, and you can see that you can see this downtrend that's come through. But again, you just look at this level of resistance, 86.62. If we break through that level on a closing basis, weekly basis, then that $100 mark is going to come into fruition. My best guess is that we're probably likely to trade down into the former downtrend, and that possibly could be a buying opportunity there into 76.13. US crude's a similar situation. Obviously, you're going to see those two working pretty much in tandem. Let's take it off a monthly chart. Again, it looks pretty heavy, and again, I think we could probably trade down into 76.93. It really depends what OPEC do. So the playbook is OPEC come out, leave the status quo as, they reject what they're saying from the US, they stay with 400,000 barrels. You could see a little bit of a move higher in the oil price on the back of that. It then flips to the OECD nations. They're talking about potentially using their strategic petroleum reserves as a sort of tactical weapon. If that noise ramps up, then you are going to see a situation where crude's going to trade lower. Of course, if OPEC do see to the pressure that the US are putting on them, then you could see oil come off very, very sharply in the situation. Let's say OPEC increase that output up to 600 to 800,000. I think the UAE will be most kind to that situation. You are going to see prices dive pretty quickly down into these levels here, maybe drop $4 or $5 in a fairly short period of time. So that's the risk. The high probability is they continue with the output agreement of 400,000 barrels, but then obviously the situation comes as to do OECD. So I think crude prices in the session ahead are going to be very, very key. If we do see a situation where oil gets smashed, which I'm not saying is going to happen, and in fact it's probably a low probability, but if it does, you are going to see real rates moving higher, and I think that will probably be a negative for the gold market as well. So a big lot to look out for. We're watching for the Bank of England. We're still watching for this OPEC meeting in the session ahead. It could have some big volatility like we've seen, and of course non-farm payrolls on the Friday session as well. So still lots to look out for, but some interesting shapes to look out for. Big 2022 ahead. I still think that the US dollar at this stage is looking tactically like it could be quite a good place to be for 2022. Anyway, if you find yourself liking the video, hit the like button, subscribe, and I'll see you next week. Thanks.